Hello, this is the coach from winningstockcoach.com. Going to talk a little bit about our market overview for the upcoming week. Members of the coaches roster, you can be expecting the week's watch list and trade plans to be following soon. Those of you with the practice squad, my free mailing list, I would hope that the market overview lessons that I've put out to you have at least given you an understanding of why sometimes good stocks fall and bad stocks go up in correlation with overall market direction. So over the past couple weeks, we've seen some really interesting occurrences after the entire year, basically, of 2013, seeing a market that quite literally reacted as any news is good news. We all of a sudden have found that we have a market that's skeptical, where any news isn't necessarily good news until this past Friday. Last week I talked to you about the importance of specific trend lines, and then also with the non-farm payroll data report that was due out on Friday. Now understand, as you read through that report, and I encourage you all to do so, because I think the non-farm payroll data is one of the most important federal data releases when it comes to the markets in general and overall market performance. Now, if you read through this data, you'll find that while many things were not good in this report at all, there was one thing that at least gives a glimpse of an explanation of why the markets rallied. Now, that thing would be the unemployment number. On the prior report, we had a 6.7% national unemployment rate, and on this report this past Friday, they reported a reduction to 6.6%. Now, you also have to understand how they get these numbers. These are the people that they consider actively looking for work, and basically just those that are still eligible to receive unemployment benefits. With extensions not being granted as they had in the past, and all of those great things, people that have been out of work and may still be looking longer than that allocated time that the government will extend unemployment benefits for, well, those people are now just considered not looking for a job. So because there have been no extensions granted to the unemployment system, we begin to see a reduction in the reported unemployment rate. It's a sad reality, but it is a reality, and we got a bit of a jump off it, and there's explanation for it, suitable explanation for it. Coming into looking at our charts for the indices, I had some feedback in the past week or two, people really enjoying the coverage I've done and the accuracy I've had with it, and how simple I made it for them to understand. And I'm going to continue that. There's many ways to look at a chart. Normally I look at candle charts, and I do all my little technical analysis and such in relation to a full spectrum of price ranges on different views of charts. But one can learn a lot from taking a very simplistic approach. So this week I'm taking that very simplistic approach to give you an understanding of the hows and whys we saw what we did and what we could still very well see. Now, that is not a bearish statement nor a bullish statement. One thing that I've set out to do is give you a perspective of what actually is happening. And I tell members of the coaches roster in our chat room all the time that you have to look at these charts as not what you would like them to do, but what they are doing, because it very, very greatly improves your trading when you do so. So up here in front of you, I've got the chart for the DJI. If you were to use your broker's charting system, you could type this in starting with the dollar sign, capital D, capital J, capital I. This is your Dow Jones Industrial Average chart. Now, this is one that's widely reported, even though it pretty much covers 30 stocks, and the average ups and downs within them. It's so generally covered that it has a lot of controlling an overall market reaction. So on the chart in front of you see two channels. Very, very easy technical analysis for us to get started with here. These two channels, the first one starts at the time when the market low was made back in March of 2009. And we have another, what I generally call a minor channel or a sub-channel that began the second week of November in 2012. Now, there's a lot of significant things that were going on during this period, and you're going to see channels that started in other indices about the same time during this video. And if you take the time to go back and research things that were happening around that time in 2012, you'll see why the market made a shift from the trend line it was very steadily trading in to a more rapidly ascending channel. Now, channels are great for traders, whether you're a novice or an experienced trader, because not only does it give you a buy point, if you'd say, we call that support, the bottom line. It also allows you to project a target, which we would call resistance, to allow you to plan trades and also make a proper assumption for your risk to reward ratio, which is very important as well. Whether it comes to following major indices or trading individual stocks, what you need to understand is the correlation between the two is very, very important. One thing we've talked about in a prior video as well is how you can use the beta rating on your stock. Many brokers, if you log into your broker website, you can find the beta, B-E-T-A, of the stock. And what that is it's a multiplier on average, and some brokers use a 3-year, some use a 5-year, but it's a multiplier on average of how the stock performs with the indices it trades within. And the way to use that is very, very simple. If you have a beta rating greater than 0, a positive beta rating, then what you'll find is your stock over the period of 3 or 5 years, however your beta is reported with your broker, tends to follow the market in relation to a multiple of the market's reaction of the beta value. This is why you see stocks with positive beta go up when the indices go up and go down when the indices go down. But it can also be used to find stocks with a negative beta, a beta below 0, for those industries and sectors that tend to perform well when markets go down. So having an idea of indice trading, your stock's beta rating, as well as support and resistance that can be simplified to you very, very easily, will improve your trading overall and allow you to not just make successful trades, but understand how to make successful trades. Here on the DJI chart, you see the two channels, and the one thing that does concern me, regardless of the up move that basically happened, Wednesday we saw a decent bounce made. Thursday was a pretty heavy day, and Friday we continued to the upside. The one thing that concerns me is the overall failure of our minor channel, the shorter term channel. You see here that we have multiple bottoms, 1, 2, 3, 4 areas that served as support in correlation to this trend line. A couple weeks ago, this support was failed. Many times what you find is, just like on the way up, and we can use any one of these up trends that you can clearly see, nothing just went straight up, nice and well defined. You get ups and downs where your ups go higher than the last up, and your downs are still higher than the last down, also called higher highs and higher lows. When you begin to see these shorter term channels failed, the support level failed, it doesn't mean that there will not be any more up move, because just like there are still down moves in an uptrend, there will always be up moves in a downtrend. What we have to focus on is whether our highs and our lows are higher or lower than the previous ones made to dictate to us a trend or a direction the chart is trading in. Now, you can see the last low that was made right over here as the chart curled down is actually higher than the low that was made down here. Because of the lower low that was made, one would expect a lower high to be made on any subsequent bounce. Once that high is made and confirmed, whether it to be higher or lower, if the high does tend to be lower, you begin to connect now a new trend line across the tops, giving you a new channel and a way to project how the chart might trade. Regardless of the up move made here, that I believe could still have a little more left in it based on the trading patterns we saw through the latter part of this past week, I do not personally think that the highs will be broken. Now, that's not meaning to be a bearish person, because I still believe that we will continue to trade in this major channel, this longer term trading channel, indicated with these purple lines, that began as the market bottomed in 2009. In fact, one would have to look at this major channel and be encouraged by the opportunities that may be presented should prices return down to this bottom line. As a matter of fact, your profit chances will be much higher. Your implied volatilities should be greater on a positive move from this line. So even the best of the bulls out there would most likely be welcoming to a bit of a retracement down to our lower channel area. Now, that does not mean it has to happen, but what we do have before us is concerning in the sense that we have clearly failed a channel that was held for well over a year and was failed as the reduction to quantitative easing began to not just be announced, but to actually take place in the marketplace. If you look at how quantitative easing was scaled into the market through what's commonly called QE1, QE2, QE3, you will find that this blue channel and the time it started and the time you'd have to say it failed are in high correlation to the induction of new monies being brought forth by the Treasury into the bond buying. And now as we see the relaxing of that, or the tapering from it, we begin to see that trend fail, while good traders feel no danger at this point, knowing that it isn't until this line fails that there's any reason for major concern. I'm going to take you over now to the RUT chart. This is the Russell 2000, commonly known as the small cap index. And again, we see a major channel, a long-term channel since the time that the market had bottomed back in March of 2009 until the current time. And again, that mid-November 2012 trend and uprising, where we have 1, 2, 3, 4, 5 different bottoms made off of this trend line. And unlike the DJI chart, we've not only failed it, we actually rapidly failed it. But also, unlike the DJI chart, we have yet at this point to make a lower low than the lows that were made in early December. Now, one thing that does concern me overall with this in general is that the Russell 2000 chart, though it be the small cap index, has always been a bit of a leading indicator that I've found time and time and time again as to how the overall indices may follow. Meaning, when people see, or when people begin to have concerns in the markets, they are generally going to exit on stocks that are more susceptible to a downturn. Those would be your small caps, your lower float, your higher volatility and lower price. They don't need as much of a move to equal higher percentages. And when there's time for concern, you tend to see the RUT chart lead the other indices in a nature of money exiting and also entering. You tend to see that support level bounces are generally made leading the other indices because of the same reasons it leads on the exits. When there's time of great confidence, good overall market news, generally you'll see entries being made into the small caps because people can take smaller and speculative entries before dedicating large amounts of money on confirmed bounces in the larger indices. So the RUT, I've always used this as a leading indicator and wasn't too happy, to be honest with you, with the weekly close on it. In fact, the clear failure of a channel that I've traded successfully since the end of 2012 for very large amounts of profits leads me to believe that, though it doesn't have to, we will at least at a minimum see a change in the angle of any possible new trading channel. That minor channel being failed leaves us waiting for a confirmation on the next high to dictate the overall trend, but we can at least assume safely that the shorter term trend is no longer there. Now, if the shorter term trend is no longer there, but the longer term trend is being held, we would have to assume that now that we've come off the top line of this major channel, the blue one, the longer term one, that we may find our way to the bottom line. Now that could come in a rapid fall like it did here, where we made a little bit of a fall, a dip, we did come back, and then we headed to the bottom line. It can also be made through horizontal movement. That would be consolidation until the time when we reach the channel bottom. The point is, no reason to really fear until this bottom line is hit, unless you didn't buy on this bottom line on one of the multiple times that it was bounced from. If you made your buys in the small caps at a time when this purple or the minor channel was bounced from, then you've been given your validation of a change in trend. There's a common saying in trading that the trend is your friend, and also don't buck the trend. When the trend is good, you will have a good time. But when the trend has failed, sometimes it is time to reduce at a minimum, if not exit, until a new trend can be verified. Finally, we're going to go to the SPX chart, which this is our S&P 500, and we see again the same major channel that began when the market bottomed back in March of 2009. And we see that in relation to the major channel, we've made series of tops and bottoms, and most of our trading, if not all, has been performed between the two purple lines, the top and bottom line. And then we see that minor channel beginning again right in mid-November 2012, where we have 1, 2, 3 secure bottoms, 4 if you count that the actual price did hit it on Wednesday of this past week. But you see a bit of a curling up without failing this channel. This would lead you to believe at this point in time that the minor channel is still the trend in effect, but in seeing on other indices that the channel, this same term of channel, has already begun to be failed, it needs to leave you, I won't say cautious or too leery to enter a trade, but willing to exit should the trend line be failed. And so long as you are willing to exit should the trend line be failed, you keep your losses at a minimum while still reading the chart technically, which says, hey, every time we've bounced off of this line, we've had extremely profitable opportunities. So the upcoming week should be quite a bit interesting as it relates to the indices to see, do we have a little more upside? Do we continue the S&P 500 in the channel it's been trading in since November of 2012? Do we maybe see, after a failed minor channel, the Dow Jones Industrial Average simply make enough of a rise just to go back and give an exit, as it retests the bottom line that it failed? Do we see the small cap index, the Russell 2000, continue to slide? Now, the one thing to understand with these charts that I'm showing is these are weekly charts, and the value will be based on the close of the week. So you can get some up and down both intraday and throughout days of the week. But these channels, these that have been formed over longer periods of time, to now see failures with the Dow Jones Industrial Average and the Russell 2000, you need to be very, very cautious in small cap trading should we not make a significant move to the top side, or should any topside move pull back before making a higher high. A lower high than what's already been made in any of these instances would give you a chart pattern that's commonly known as a head and shoulders. And if we were to get those head and shoulders, I'd be looking for a target around 1144 to 1145 on the Russell 2000, the RUT chart, where we would call the left shoulder a high made before the higher high, the head being the higher high, and the right shoulder being a high that's closely in proximity to that left shoulder before what leads to one of the most bearish indicators as far as chart patterns go. This is the coach from winningstockcoach.com, encouraging you to use the market overviews to assist in your trading, to understand how indice trading correlates to the equity trading you may be doing on individual stocks, and also allows you to understand why your stock may not always go up even though the news is good, and why your stock may not always go down even though there may not be anything necessarily great happening at the time. Looking for opportunities and reading a chart based simply on the trend of the chart and the lows and highs that it's making will allow you to make better decisions for more profitable trades and minimal risk for the trades that you may enter, so long as you exit when the signs are given to you.